Before we begin, please note that the information provided in this video is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent. The content presented here is not intended to be a substitute for professional financial or insurance advice. Always consult with a qualified professional before making any decisions about your car insurance coverage. The average 16-year-old driver in the United States pays over $7,000 a year for their own car insurance policy. Let that sink in. $7,000. For many, that's more than the value of the car they're driving. It's a full-time minimum wage job just to have the legal right to drive to that job. You finally get your license. You feel that surge of freedom, that rite of passage you've been dreaming about for years. You scrape together every dollar you've ever saved, you work a summer job, you buy your first car. It's not a Lamborghini, it's probably a 10-year-old Toyota with a weird smell. But it's yours. It's freedom on 4 wheels. Then the insurance quote arrives in your email, and your heart sinks. It's a number so outrageously high it feels like a typo, feels like a punishment, feels personal. You start asking questions. How is this possible? I'm a good driver. I've never even had a ticket. This has to be a scam, right? They're just taking advantage of me because I'm young. And that feeling, that gut punch of injustice, is exactly what this video is about. Because it's not a scam, it's not a typo, and it's not personal. It's math. Cold, hard, unforgiving math. And the insurance companies are betting billions of dollars that you don't understand how that math works. Well, today we are pulling back the curtain. Over the course of this presentation, we are going to dissect the entire system. We're not just going to tell you, it's expensive because you're a risk. That's lazy. You already know that. We are going to expose the specific, hidden factors that insurance companies use to calculate that terrifying number on your screen. We'll decode the industry's secret language, and most importantly, we will give you the actionable playbook, the step-by-step strategies, to systematically lower your premium. By the end of this, you won't just feel less angry. You'll be armed with the knowledge to fight back and save thousands of dollars. So let's get into the first and most fundamental reason your insurance costs a fortune. It has nothing to do with your car, your grades, or where you live. It has to do with the physical wiring of your brain. Yes, neuroscience is the #1 reason you're considered a massive financial liability. Specifically, we're talking about a part of your brain called the prefrontal cortex. Think of the prefrontal cortex as the CEO of your brain. It's the little guy sitting in the corner office responsible for rational decision-making, impulse control, understanding long-term consequences, and managing risk. It's the part of your brain that stops you from texting back while you're doing 70 on the highway. It's the voice that says, hey, maybe trying to beat that yellow light with 3 of your friends in the car isn't the best idea. Here's the problem. Your prefrontal cortex is not fully developed until you're about 25 years old. This isn't an opinion. It's a biological fact confirmed by decades of neurological research. So, for a teenager, the parts of the brain that are fully online are the ones that control emotion, reward, and excitement, the amygdala and the limbic system. This creates a massive imbalance. You have the biological gas pedal of a race car, the desire for fun, social connection, and thrills, but you have the developmental brakes of a bicycle. Insurance companies don't see a 17-year-old kid. They see a brain that is biologically hardwired to underestimate danger and overestimate its own abilities. They see a neurological predisposition for risk-taking. And before you say, that's not me, I'm a responsible driver, you have to understand that insurance is not about you as an individual. It's about the group you belong to. It's a game of statistics, and the statistics for your age group are frankly terrifying. And they are a direct result of this brain development gap. Let's look at the data that insurance actuaries, the mathematicians who calculate risk for a living, are staring at all day. According to the Centers for Disease Control, the CDC, motor vehicle crashes are the leading cause of death for U.S. teens. Despite representing only about 7% of the U.S. population, drivers aged 15 to 19 account for a disproportionately high percentage of the total costs of motor vehicle injuries. Let's get even more specific. The National Highway Traffic Safety Administration, or NHTSA, found that for every mile driven, teen drivers are almost 3 times more likely than drivers aged 20 and over to be in a fatal crash. 3 times. Imagine you're running a casino, and one group of players at the blackjack table loses 3 times more often than everyone else. What would you do? You'd charge them more to play the game, or you'd stop letting them play altogether. That is precisely the cold calculation an insurance company makes. They look at the data on speeding. Teen drivers have the highest proportion of fatal crashes related to speeding. They look at seatbelt use. Teens and young adults have the lowest seatbelt use rates of any age group. They look at distracted driving. That phone buzzes, and a teenage brain, with its underdeveloped impulse control and heightened need for social connection, is far more likely to glance at it than a 40-year-old brain. Each of these behaviors is a direct reflection of a brain that's still under construction. So when that insurance underwriter looks at your application, they aren't seeing you, the honor roll student who volunteers on weekends. They are seeing a statistical profile. They see the undeveloped prefrontal cortex. They see the crash rates. They see the fatality statistics. They see a multi-million-dollar lawsuit waiting to happen. They aren't insuring your 2012 Honda Civic. They are insuring against the catastrophic financial risk posed by a brain that is scientifically proven to be ill-equipped for the immense responsibility of operating a 2-ton metal box at high speeds. It's not an insult. It's an actuarial assessment. It's the foundational layer of your high premium. This biological reality is the bedrock upon which all the other pricing factors are built. But this is just the first piece of the puzzle, because your brain chemistry is something you can't control. However, there are numerous other factors that are actively driving your rates through the roof, many of which you have far more influence over than you think. And the second biggest factor has nothing to do with you at all, but everything to do with the people you're most likely to have in your car with you. So let's talk about your friends. Because when an insurance underwriter looks at a 16, 17, or 18-year-old driver, they don't just see you. They see a car full of your friends. And statistically, that is one of the most dangerous scenarios on the road. The Centers for Disease Control, the CDC, has studied this extensively. For a teen driver, the risk of a fatal crash increases with each and every additional teenage passenger in the car. One teenage passenger doubles the risk of a fatal crash. 2 teenage passengers triples the risk. 3 or more, and the risk skyrockets to 4 times higher than driving alone. Think about that. 4 times higher. Why? It's not a mystery. It's distraction. It's the music turned up too loud. It's the conversation, the laughing, the shouting. It's the social pressure to drive a little faster, to take a corner a little sharper, to check a text message that just came in. It's everything that pulls your attention away from the 1.5-ton machine you're piloting down the road. Insurance companies aren't heartless. They're data-driven. They have a century of accident reports, and those reports tell a terrifyingly consistent story. Teen drivers with teen passengers are a massive liability. They're not charging you more because they think you're a bad person. They're charging you more because they know the power of peer pressure and the science of the distracted teenage brain. It's a statistical certainty that a car full of teenagers is one of the biggest gambles on the road, and you are paying the premium for that risk every single month, whether you're driving your friends or not. But that's a factor you can't entirely control. The real question is, what can you control? This is where we peel back the curtain on the insurance company's playbook. They are in the business of predicting the future. Your future. They build a profile of you, a sort of predictive model, using a handful of key data points. And your job, if you want to save thousands of dollars, is to make your profile look as boring and predictable as humanly possible. Let's start with the most obvious one. Your driving record. This is your driving resume. It's the first thing they look at, and it's the most heavily weighted. A clean record is gold. A single speeding ticket, however, is not just a fine you pay to the court. It's a fine you will pay to your insurance company month after month for the next 3 to 5 years. Let's break down the math. A ticket for going, say, 15 miles per hour over the speed limit can easily increase your premium by 20 to 25%. If you're already paying that astronomical rate of $300 a month, that's an extra $60 or $75 every single month. Over 3 years, that one little mistake, that one moment of impatience, has cost you over $2,000 in extra insurance payments alone. And it's not just about the ticket itself. It's about what the ticket represents. To an insurer, that ticket says you're a risk taker. You're willing to break the rules. You're more likely to be in a situation where an accident could happen. An at-fault accident on your record? That's the nuclear option. That can double your rates overnight, or even get you dropped by your insurer entirely, forcing you into a high-risk pool with even more punishing premiums. Your driving record is a story you write every time you get behind the wheel. Keep the pages clean. Every minor infraction is a permanent mark in the early chapters of your driving history, and insurers have very, very long memories. The second factor is one of the easiest ways to save a huge amount of money, yet so many young drivers and their parents completely miss it. It's your report card. Your grades. Yes, your performance in algebra class directly impacts your car insurance rate. It's called a good student discount, and it's one of the most significant discounts available to young drivers, often saving you anywhere from 10 to 25%. Why on earth would an insurance company care if you can pass a history test? It all comes back to their predictive model. The data shows a strong correlation between academic responsibility and driving responsibility. Students who maintain good grades tend to be more cautious, more disciplined, and less likely to engage in risky behavior, both in the classroom and on the road. A B average or a 3.0 GPA is typically the magic number. If you have that, you call your insurance agent immediately. You send them a copy of your report card. It is, without a doubt, the highest paying part-time job you can have in high school, making an extra $500 or $800 a year just for doing the schoolwork you were already supposed to be doing. It's a no-brainer. Okay, so you're a safe driver with good grades. What's next? The car itself. The vehicle you drive is a massive piece of the puzzle, and it's far more nuanced than just don't drive a red sports car. Insurers break this down into three critical areas: safety, repair costs, and theft risk. First, safety. Before you ever buy a car, you need to look up its safety ratings from the Insurance Institute for Highway Safety, or IIHS. They are the gold standard. They crash cars for a living so you don't have to. A car that gets a top safety pick award is music to an insurer's ears. Why? Because a car with excellent crash test ratings, side impact airbags, and advanced safety features like automatic emergency braking is more likely to protect you and your passengers in a crash. That means lower medical bills. And since medical claims are often the most expensive part of an accident, a safer car translates directly into a lower premium for you. Second, repair costs. This is the hidden trap of modern cars. You might be driving a sensible four-door sedan, but if it's packed with technology, lane assist sensors, backup cameras, adaptive cruise control radar embedded in the bumpers and mirrors, a simple fender bender can turn into a $5,000 repair bill. That simple plastic bumper cover now houses a complex array of electronics. A side mirror isn't just glass anymore. It's a heated, motorized, camera-equipped, blind spot monitoring computer. Insurers know exactly how much it costs to repair every make and model. A 10-year-old Toyota Corolla that gets a dented bumper might cost a few $100s to fix. A brand new crossover with the same dent could be 10 times that. Driving a slightly older, less technologically complex, but still safe and reliable car can save you a fortune. Third, theft. Every year, the IIHS also releases a list of the most stolen vehicles in America. If your car is on that list, you're paying for it. Insurers track theft data by model, year, and even by your specific zip code. This is why you've seen all the news about certain Kia and Hyundai models being stolen so easily. Insurance companies reacted instantly, dramatically raising rates or even refusing to cover those specific vehicles in certain areas. Driving a car that is not a high-profile target for thieves is another way to make your profile look boring, predictable, and most importantly, cheap to insure. Finally, we have the factor that feels the most unfair because it's about where you are, not who you are. Your location. The address where you park your car at night is one of the primary rating factors for any policy. Insurers use your zip code to price your risk. Living in a dense urban center with high traffic volume, narrow streets, and higher crime and accident rates will always cost more than living in a quiet rural area. They look at the number of claims filed in your neighborhood. They look at the weather patterns. Are you in a place prone to hail, flooding, or hurricanes? Even within the same city, rates can vary wildly from one zip code to the next. And it goes even deeper. They'll ask you where you park the car. Is it in a locked garage, a driveway, or on the street? Each of those answers carries a different level of risk for theft and vandalism. A car tucked away in a garage is a much safer bet than one left on a busy city street overnight. All of these factors, your record, your grades, your car, and your location, are combined by a complex algorithm to generate your final price. It's a cold, calculated process designed to protect the insurance company from risk. But even if you do everything right, you have a perfect record, you get straight A's, you drive the safest, most boring car in the safest neighborhood, you could still be one mistake away from complete financial ruin because of three little letters on your policy document that almost no one, especially a young driver, truly understands. And we'll break down exactly what they are and why they could be the most important financial decision you ever make in the next part. Those three little letters are actually three little numbers separated by slashes. You've seen them. Maybe they look like this: 25/50/25, or maybe 50/100/50, Or if you're lucky, 100/300/100. This isn't just jargon. This is the code that defines the absolute limit of your financial protection. This is the wall that stands between you and total financial ruin. And here's the most important thing to understand right now. These numbers have almost nothing to do with fixing your car or paying for your hospital bills. Not a single cent. These numbers are all about the damage you do to other people and their property. This is liability coverage. It's what you are legally required to have. And it's the single biggest reason your premium is so terrifyingly high. Let's break it down. Imagine a scenario. It's a Tuesday afternoon. You're 18 years old, driving home from your part-time job. You're a good driver. You've never had an accident. You're stopped at a red light, second in line. The light turns green. The car in front of you starts to go, but then suddenly brakes because a pedestrian steps off the curb. You, for one split second, glance down at your phone to change the song. When you look up, it's too late. You slam on your brakes, but you hit the car in front of you, a brand new SUV, pushing it into the intersection, where it gets T-boned by a minivan coming through the green light. A 3-car accident. And it was your fault. Everyone seems okay at first. Shaken up, but okay. Police reports are filed. Information is exchanged. You call your parents, your voice trembling. They're just glad you're not hurt. Your car is a mess, but it's just a car. For a week, it seems like a very expensive, very stressful hassle. Then the letters start to arrive. Let's look at those numbers on your policy. You have the state minimum coverage in your state, which is 25/50/25. Let's look at that first number, 25. This stands for $25,000. It's the maximum amount your insurance company will pay for bodily injury to a single person in an accident you cause. The driver of the SUV, a 45-year-old architect, is now experiencing severe back and neck pain. His doctor diagnoses him with a herniated disc that will require surgery. The ambulance ride was $1,000. The ER visit was $5,000. The MRI was another $3,000. The surgery itself is $50,000. Then there's months of physical therapy, follow-up appointments, and prescription medications. His total medical bills come to $85,000. Your insurance policy looks at that bill, and it pays the first $25,000, and then it stops. Your legal obligation is fulfilled. The insurance company has done its job, but there is still a $60,000 bill left to pay. Who pays it? You do. The architect's health insurance will likely cover a lot of it up front, but then his insurance company will come after you to get that money back. It's called subrogation, and they will sue you for it. Now let's look at the second number, 50. This stands for $50,000. This is the maximum amount your insurance will pay for bodily injury for the entire accident, no matter how many people are hurt. Remember the minivan? There was a mother and her 2 kids inside. The mom broke her arm and had a concussion. The kids had cuts and bruises and severe whiplash. Their combined medical bills, after a trip to the ER and follow-up care, total $30,000. So now we have the architect's $85,000 bill and the family's $30,000 bill. That's a total of $115,000 in medical expenses from this one accident. Your policy has a limit of $50,000 for everyone, so your insurance company writes checks totaling $50,000 and that's it. They are done. Of the $115,000 in medical bills, your insurance covered less than half. That leaves a staggering $65,000 in outstanding medical debt that you are now personally responsible for. But we're not done. We still have that third number, 25. This is for property damage. $25,000. This is the maximum your insurance will pay for any property you damage. The architect's brand new SUV has over $30,000 in damage. The minivan has about $12,000. And the first rule of finding smart insurance is to stop thinking like a customer and start thinking like an underwriter. You need to play their game by their rules and win. The game is called Prove You're Not a Risk. And your first move, the opening gambit, is to collect every single discount you are entitled to. I'm not just talking about the obvious ones. I'm talking about stacking discounts so high they start to look like a real salary. Let's start with the one everyone knows, but almost no one maximizes: the good student discount. Most insurers offer this, and it can be significant, often between 10 to 25% off your premium. The standard requirement is AB average, or a 3.0 GPA. But here's where people mess up. They either don't know about it or they assume they don't qualify and never ask. You have to be proactive. You need to get an official transcript or a report card and send it to your insurance agent every single semester or grading period. You can't just tell them, "Yeah, my kid's a good student." You have to prove it with documentation repeatedly. But what if you're just under a 3.0, say a 2.9? Don't just give up. Call your agent. Explain the situation. Ask if there are other academic qualifiers. Some insurers will also give the discount if you score in the top 20% on standardized tests like the SAT or ACT. So if you're a great test taker but struggle with homework, that's your angle. What if you're homeschooled? They have a path for that too, usually requiring a high score on a standardized test. The point is, don't take the first no for an answer. The good student discount is the easiest money you'll leave on the table if you're not persistent. Next up is the defensive driving course. This is an absolute no-brainer. These are typically state-approved courses, often available online, that take a few hours to complete. They teach you about hazard perception, accident avoidance, and the rules of the road in more detail than your standard driver's edition. Now you might think, I already know how to drive. Why waste a Saturday and $50 on a course? Here's why. That $50 investment can unlock a recurring discount of 5 to 15% that lasts for 3 years. Do the math. On a $4,000 annual premium, a 10% discount is $400. You spend $50 to make $400 in the first year alone. Over 3 years, that's a $1,200 return on a $50 investment. That is one of the best financial returns you will ever see in your life. But again, you have to play the game right. Not just any online course will do. It has to be a course approved by your state's DMV, and crucially, recognized by your specific insurance carrier. Before you sign up for anything, call your agent and ask for a list of their pre-approved courses. Get it in writing. Then take the course, send them the certificate of completion, and watch the numbers drop. Now for a huge one that a surprising number of people miss: the student away at school discount. This is for parents whose kid is going off to college. If the college is more than 100 miles from home, and the student does not take a car with them to campus, you can get a massive discount. We're talking 15 to 30%, sometimes more. The logic from the insurer's perspective is simple. If the car is parked at home in one state, and the riskiest driver on the policy is living in a dorm room 150 miles away, the chance of that driver getting into an accident plummets. They're only driving during holidays and summer break. This transforms them from a daily risk into an occasional risk. But this discount is not automatic. The insurance company doesn't know your kid moved into a dorm. You have to call them, tell them the situation, and provide the school's address as proof. For parents paying a fortune to have their kid on the policy, this single phone call can save over $1,000 a year. Okay, let's talk about the big one, the controversial one, the one that can either save you a fortune or feel like a massive invasion of privacy. I'm talking about telematics, also known as usage-based insurance. This is the black box program. You either plug a small device into your car's OBD2 port, that's the little port under your steering wheel, or you download an app on your smartphone that tracks your driving. This device becomes a spy in your car. It monitors your driving habits in real time. It tracks your speed, how hard you brake, how quickly you accelerate, what time of day you drive, and how many miles you cover. I know it sounds a little like Big Brother is riding shotgun, and for some people that's a deal breaker. But let's look at the upside. If you are a safe driver, or if you can act like a safe driver, this is the single fastest way to slash your premium. The insurance company is no longer guessing about your risk based on your age. They have cold, hard data. They can see that you don't tailgate, that you don't slam on the brakes, that you're not drag racing at 2 in the morning. Most programs work like this. You get a small, immediate discount just for signing up, maybe 5 or 10%. Then, after a trial period, usually 90 days to 6 months, they analyze your driving data and assign you a safety score. A high score can lead to a total discount of up to 40%. That is a game changer. It's a direct way to prove the statistics wrong. You're telling the insurer, don't judge me by my age. Judge me by my actions. The key is to know what they're looking for. The biggest red flags are hard-braking events, rapid acceleration, speeding, and late-night driving, especially between midnight and 4 a.m. If you can consciously avoid those things during the monitoring period, you can lock in a massive discount for the life of your policy. It's like a driving report card that pays you for good grades. But the discounts don't stop there. Think about every group or organization you or your parents belong to. Are you a member of an honor society like Phi Beta Kappa? There's a discount for that. Are your parents members of a university alumni association, a credit union, or a professional organization like the American Medical Association or the Bar Association? Many of these groups have negotiated special group rates with insurance carriers. It's an affinity discount. Go through every membership card in your wallet. It's a few phone calls, but one of them could unlock a hidden 5 or 10%. Finally, let's talk about bundling, but not in the way you think. Everyone knows you can save by bundling your auto and home insurance. But what if you don't own a home? Here's the pro-level move. Bundle your auto insurance with the renter's policy. Renter's insurance is incredibly cheap, often just $10 or $15 a month. It protects your stuff, your laptop, your TV, your clothes in case of theft or fire. Most young people don't think they need it. But here's the secret. The discount you get on your car insurance for adding that renter's policy is often more than the cost of the policy itself. You could pay $12 a month for renter's insurance and see your $300 a month car insurance bill drop by $25. You are literally being paid $13 a month to have your belongings insured. It's a financial loophole. You get free insurance and you save money on your car. So let's put it all together. Imagine a 17-year-old with a 3.5 GPA. They take a defensive driving course. They sign up for a telematics program and drive like a saint for 3 months. Their parents bundle the policy with their renter's insurance. Suddenly, that horrifying initial quote of $5,000 or $6,000 a year is cut by 30, 40, even 50%. It's not magic. It's a system. It's about methodically layering every single advantage you can get. But even with all these discounts, there is one factor that can undo all of your hard work. One decision that can make your insurance affordable or completely catastrophic. And it's a decision most young drivers and their parents make based on emotion, not on data. All these strategies are just one half of the equation. The other half, the one that can have an even bigger impact on your final premium, is the car itself. Choosing the right vehicle is not just about safety ratings and fuel economy. It's about understanding how insurance companies see that specific make and model. And the way they see it is often completely different from the way you do. It's a world of pure, unadulterated data. Imagine a massive digital profile, not for a person but for a car. Every single car model has one. A 2018 Honda Civic, a 2020 Ford Mustang, a 2015 Toyota Camry. Each one has a file, a rap sheet that's millions of data points deep. This file tracks its entire history in the hands of the public. How often is it stolen? When it crashes, what's the average repair bill? How likely are its occupants to be seriously injured? What parts cost the most to replace? This isn't a guess. It's a statistical certainty, calculated to the 4th decimal place. And when a young driver is paired with a car that has a bad profile, the result is an insurance premium that can feel like a punishment. Let's start with one of the most brutal and recent examples of this in action: theft. You've probably heard of the Kia Boys trend that exploded on social media. A viral video showed how certain Kia and Hyundai models made before 2021 could be stolen in under a minute using nothing more than a USB cable. The video spread like wildfire. And predictably, thefts of these cars skyrocketed. In some cities, they jumped by over 1,000%. Now, put yourself in the shoes of an insurance company. Suddenly, your data feed is screaming red alert. Tens of thousands of your customers are filing theft claims for these specific models. You're paying out millions upon millions of dollars to replace stolen cars. What do? You can't go back in time and install the immobilizer that the manufacturer left out. You have to react to the new reality. So, the algorithm does its job. The risk profile for a 2017 Hyundai Elantra or a 2019 Kia Forte is rewritten overnight. The variable labeled theft_risk goes from low to extreme. As a result, the insurance premiums for these cars go through the roof. Some insurers even refuse to write new policies for them in certain areas. Imagine you're an 18-year-old who just saved up $5,000 for your first car. You find a great deal on a used Kia. It's reliable, it gets good gas mileage, it's exactly what you need. You buy it. Then you call to get insurance, and you're quoted a price that's more than the monthly car payment itself. Or you're just flat out denied. You did nothing wrong. You're not a car thief, but you own a car that is a magnet for thieves. And in the cold, hard world of insurance, you have to pay for that risk. You are now financially linked to the actions of thousands of strangers on the internet. That's how deeply the car's own identity affects your bottom line. But theft is just one chapter in the car's story. The next one is about what happens after a crash. Let's talk about the cost of repairs. This is where the modern car, with all its amazing technology, becomes its own worst enemy from a financial perspective. Picture two 19-year-olds. Let's call them Alex and Ben. They both have identical driving records and live in the same town. Alex buys a 10-year-old basic reliable sedan, a simple car. Ben buys a newer but still used entry-level luxury sedan. It's not a supercar, just something with a nicer badge, leather seats, and a few more tech features. On paper, they seem pretty similar. One afternoon, Alex is backing out of a parking spot and misjudges the distance to a concrete pillar. Crunch! It's a classic low-speed mistake. He cracks his taillight and puts a dent in his bumper. It's embarrassing, but the fix is straightforward. A new taillight assembly costs about $200. A new unpainted bumper cover is $300. With labor and paint, Alex's insurance company is looking at a claim for maybe $800 to $1,000. An annoyance, but manageable. The very next week, Ben does the exact same thing in the exact same parking garage. Crunch! He hits the pillar in the same spot. But his experience is completely different. His taillight isn't just a simple bulb in a red plastic housing. It's a full LED unit with complex sweeping turn signals. The replacement part alone is $700 from the dealer. And his bumper isn't just a piece of plastic. It has two ultrasonic parking sensors embedded in it. Those sensors are now damaged. They cost $150 each. And they don't just get replaced. The entire system needs to be recalibrated by a technician with specialized equipment, which adds hours of expensive labor. By the time it's all said and done, Ben's identical low-speed mistake results in a claim of over $3,000. The insurance company doesn't see Alex and Ben. It sees two claims for the same type of accident. One cost $1,000. The other cost $3,000. Over time, they process millions of these claims. The data becomes undeniable. Car B is 3 times more expensive to repair than Car A. Therefore, the collision coverage for Car B must be significantly more expensive. It has nothing to do with Ben being a worse driver than Alex. It has everything to do with the fact that he chose a car where a simple mistake carries a much heavier price tag. This brings us to the great paradox of modern vehicle safety. We are all told that a safer car will mean cheaper insurance. And that is true, but only up to a point. Your car getting a 5-star crash test rating is obviously a good thing. It means you're less likely to be seriously injured, which reduces the potential for massive medical claims. The most expensive claims of all for an insurer. But why is the car so safe? It's safe because of meticulously engineered crumple zones designed to absorb impact. It's safe because it has 10 airbags that deploy from the front, the sides, the ceiling, and even from under the dashboard to protect your knees. It's safe because of a suite of advanced driver assistance systems, ADAS, for short. Your windshield has a camera for lane keeping assist. Your grille has a radar sensor for adaptive cruise control. Your side mirrors have sensors for blind spot monitoring. These are technological marvels that save lives. But they are astronomically expensive to repair and replace. That crumple zone does its job by sacrificing the entire front end of your car in a moderate collision. Those 10 airbags that deployed? They can cost over $1,000 each to replace, not including the labor and the new dashboard or seat covers they ripped through. A simple cracked windshield is no longer a $300 fix. If it has the camera mounted to it, the replacement can be over $1,500 because the system has to be perfectly recalibrated, or your lane keeping assist could steer you into a ditch. So you have this bizarre tug of war. The features that make the car safer for you, the human, make the car itself more expensive to fix. An accident that you would have walked away from 10 years ago with a $4,000 repair bill might now result in the car being declared a total loss. The repair estimate, with all the sensors and calibrations, might be $12,000 on a car that's only worth $15,000. It's cheaper for the insurance company to just write you a check and sell the wreck for salvage. More total loss declarations for a specific model mean a higher risk profile. Higher risk means higher premiums. And finally, we have to talk about the car's personality, or as the insurance industry sees it, its performance potential and target demographic. Let's bust the red car myth right now. Insurers do not care what color your car is, but they care immensely about what's under the hood. A 17-year-old looking for a first car might be considering a Ford Focus. They might also be considering a Ford Mustang. To the teenager, the Mustang is just cooler. It's the dream. To the insurance company, the Mustang is an entirely different species of risk. It's not about judging the teenager's character. It's about data. The data shows that, on average, a V8-powered, rear-wheel drive sports coupe is involved in more frequent and more severe accidents than a front-wheel drive economy sedan, especially when the driver is under 25. They know this. They have decades of claim data to prove it. They know that a car with 300 horsepower is more likely to be driven at excessive speeds than a car with 150 horsepower. It's what the car was built for. They know which models are popular for street racing. They know which models have a high incidence of single-vehicle accidents, which often points to a loss of control. A car like a Subaru WRX, a Volkswagen GTI, or a Honda Civic C is a flashing red light in the system. These are incredible fun cars. But they also have a statistical history of being driven aggressively and being modified by their owners. The insurer isn't assuming you, personally, are going to be reckless. They are assuming that a significant percentage of people like you, meaning your age demographic, who buy that specific car will be. They are playing the odds. And the odds are not in your favor. So when you, as a young driver, get a quote for a 2019 Honda Civic LX sedan and a 2019 Honda Civic C Coupe, the difference in price will be staggering. The cars look similar. They share the same basic platform, but one is seen as a responsible commuter car, and the other is seen as a performance-oriented risk. The key takeaway is this. The car is not a blank slate. It arrives with its own history, its own baggage, its own statistically proven identity. Before you fall in love with a car on a dealer lot, before you even take it for a test drive, you need to treat the insurance quote as a primary feature of the vehicle, just as important as its mileage or its color. Get the vehicle identification number, the VIN, from the dealer. Go to 3 different insurance websites and plug it in. Get a real quote. Then do the same for a boring alternative like a Toyota Corolla or a Honda CR-V. The numbers you see on the screen will tell you the car's real story. They will reveal the hidden costs baked into its DNA by years of real-world data on theft, repairs, and risk. Choosing the right car isn't about denying yourself something you enjoy. It's about walking into the biggest financial decision of your young life with your eyes wide open, understanding the full price of your choice. You can do everything right, be a safe driver, get good grades, take defensive driving courses. You can build the perfect driver profile. You can even choose a car that seems smart and safe. But you can still get it catastrophically wrong with just 2 or 3 simple clicks on the coverage selection page. Those clicks are the difference between a minor inconvenience and financial ruin. And most young drivers and their parents are making the wrong choice without even knowing it. We'll break down exactly what those choices are and how to get them right next. Alright, let's talk about the single biggest mistake made when insuring a young driver. It's a trap, and it's disguised as a smart, money-saving decision. It's called buying state minimum coverage. Every state, except New Hampshire, legally requires you to have a minimum amount of liability insurance to drive. And when you're getting quotes, that state minimum option is always the cheapest. It looks tempting. You see a price that's maybe $200 a month instead of $400, and you think, great, I'm saving a fortune. I'm legally covered. What's the problem? The problem is that state minimum coverage is like buying a parachute that's legally required to have a harness and a ripcord, but it's made of tissue paper. It meets the bare-bones legal definition, but when you actually need it, you're in for a terrifying fall. These minimums were often set decades ago, when a new car cost $3,000 and a hospital stay was a few $100. Today they are catastrophically inadequate, and relying on them is the #1 path to financial ruin for families with young drivers. To understand why, you need to understand the 3 core pillars of car insurance. Forget the jargon for a second. Think of it like this. There's coverage for their car and their medical bills, coverage for your car, and coverage for everything else that can go wrong. Pillar 1 is liability coverage. This is the only part that's legally required. Liability pays for the damage you cause to other people and their property. It does absolutely nothing for you or your car. It's 100% for the person you hit. When you see a policy, it's usually listed as 3 numbers like 25/50/25. This is a common state minimum. Sounds like code, but it's simple. The first number is the maximum the insurance will pay for one person's bodily injuries. In this case, $25,000. The second number is the maximum they'll pay for total bodily injuries in a single accident, so $50,000. And the third number is the maximum they'll pay for property damage, that's the other person's car or maybe a fence you hit, so $25,000. Now let's see what happens when our 17-year-old driver, let's call him Leo, has a very common, very simple accident with this 25/50/25 coverage. Leo is driving home from school. He's a good kid, not texting, not speeding. But he gets distracted for just 1 second by a new song on the radio, and he doesn't see the car in front of him stop. He rear-ends a brand new Toyota Highlander carrying a mom and her son. It's not a high-speed crash, but the Highlander's bumper is crushed and the tailgate is crumpled. Leo's car is damaged too, but we'll get to that later. The mom and her son seem okay, but they both have whiplash and need to go to the emergency room. A few weeks later, the bills start coming. The mom's medical bills for the ambulance, the ER visit, the MRIs, and the physical therapy total $40,000. Her son's bills are $30,000. The repair estimate for their brand new Highlander is $31,000. The total cost of this 1-second mistake is $101,000. Now let's look at Leo's state minimum insurance. For the mom's injuries, the policy has a $25,000 limit per person, so it pays $25,000. The remaining $15,000? That's on Leo and his parents. For her son's injuries, the policy pays his full $30,000 because it's under the $50,000 total accident limit. So far, the insurance has paid $55,000. But now for the car. The policy has a $25,000 property damage limit. The repair bill is $31,000. The insurance pays $25,000. The remaining $6,000? That's on Leo and his parents. So, after the protection of their insurance, Leo's family is now personally on the hook for $21,000. The other driver's insurance company will pay to fix their client's car and cover their medical bills. And then their lawyers will come after your family for that $21 grand. They will sue you. They can go after your savings, your home equity, and even garnish your wages and your kids' future wages for years to come. That cheap policy just became the most expensive decision you've ever made. Now, what if Leo's parents had chosen better liability limits? A more responsible policy might be 100/300/100. That's $100,000 for a single person's injuries, $300,000 total for injuries, and $100,000 for property damage. Would it have cost more per month? Yes, absolutely. But in this exact scenario, it would have covered every single penny. The entire $101,000 accident would have been handled by the insurance company. No lawsuits, no wage garnishments, no financial ruin. Just a stressful situation that was properly managed by the protection they paid for. That's Pillar 1. Now for Pillar 2, collision coverage. Remember Leo's car? Liability doesn't give him a single dollar to fix his own vehicle. If he only has state minimum liability, he and his parents have to pay for the repairs out of their own pocket. If the car is totaled, it's just gone. A $10,000 loss. Collision coverage is what pays to repair or replace your car. If you're in an accident that is your fault, you choose a deductible, say $500 or $1,000. That's the amount you pay, and the insurance company pays the rest. So if Leo had a $1,000 deductible, his family would pay that, and the insurance company would cover the remaining thousands of dollars in repairs. Without it, you're just hoping your kid never ever makes a mistake. Pillar 3 is comprehensive coverage. This is for all the other chaos life throws at you. It's sometimes called acts of God coverage. This is what pays out if a tree branch falls on your car during a storm, if it's stolen, if it's vandalized, if you hit a deer on a country road. None of that is covered by liability or collision. Just like collision, you pick a deductible, and the insurance covers the rest. For a new driver whose car might be parked in a school lot or on the street, this is not a luxury. It's essential. Together, liability, collision, and comprehensive are often bundled and called full coverage. But here's a critical secret. Full coverage is a myth. It's not a real insurance term. It's just slang for a policy that has the 3 main pillars. But even with full coverage, there are still massive, dangerous gaps. And this is where the truly smart choices come in. The 2 most important coverages most people skip are uninsured and underinsured motorist protection. This is a mouthful, but it's incredibly simple. It protects you when the person who hits your kid is the one who cheaped out on their insurance. What happens if your teen is sitting at a red light and gets rear-ended by someone who has no insurance at all? Or by someone who only has that flimsy 25/50/25 state minimum, and your kid's medical bills are $100,000? Their insurance taps out at $25 grand. Who pays the other $75,000? You do. Unless you have underinsured motorist protection, it's insurance on other people's bad insurance. It steps in and covers your expenses when the other guy can't. It is one of the most important and, thankfully, one of the most affordable additions to any policy. The other is medical payments or personal injury protection. depending on your state. This covers your own medical bills and your passengers' medical bills, no matter who is at fault in an accident. It's immediate. You don't have to wait for lawyers to fight over who's to blame. You go to the hospital, you get treated, and this coverage starts paying right away. So when we talk about the cost of insurance, we're not talking about one single thing. We're talking about the cost of buying real protection versus the illusion of protection. The price tag is a direct reflection of how big of a financial shield you're building around your family. State minimum is a shield made of cardboard. A 100/300/100 policy with collision, comprehensive, and uninsured motorist coverage is a shield made of steel. So now that we understand what we're actually buying, we can finally tackle the big question. Why does that steel shield cost a 17-year-old 3, 4, or even 5 times more than it costs a 40-year-old? The answer is a cold, hard, and brutal calculation of risk, backed by mountains of data. And when you see the numbers, you'll understand exactly what we're up against. Let's start with the most brutal number of all. Per mile driven, a driver aged 16 to 19 is nearly 3 times more likely to be in a fatal crash than a driver aged 20 or over. Let that sink in. Not just a fender bender. A fatal crash. For every single mile you are on the road, the statistical likelihood of a catastrophic, life-ending event is 300% higher than it is for your parents. Insurance companies aren't just aware of this statistic. They built their entire business model around it. Motor vehicle crashes are the #1 cause of death for teenagers in the United States. Not cancer, not disease, not accidents at home. Driving. The very act of freedom that defines being a teenager is also the single most dangerous thing a teenager can do. And the risk isn't even spread out evenly. The data shows an almost terrifying curve. A 16-year-old driver has a crash rate higher than any other age group on the road. It's higher than an 18-year-old, astronomically higher than a 25-year-old, and it's completely off the charts compared to a 40-year-old. So when that insurance company gets an application for a newly licensed 16-year-old, alarm bells don't just go off in their system. A 5-alarm fire erupts. Their algorithms, fed by decades of accident reports, hospital bills, and death certificates, see a giant flashing red light. To an insurer, you are not an individual. Not at first. You are a data point. And as a young driver, you belong to the single most expensive, most unpredictable, and most loss-prone data set they have. Imagine you're the underwriter. A 45-year-old man applies for a policy. You can pull his record. He's been driving for 29 years. You can see he's had 1 speeding ticket in 2008 and a minor parking lot scrape in 2015. You have a massive 29-year-long history of his actual behavior. You can accurately predict his future risk because you have a deep well of his past performance. He is a known quantity. Now, an application for a 17-year-old girl comes across your desk. What's her driving history? 0. Her track record? A blank slate. You have absolutely no data on her individual performance, her judgment, or her habits. So what do? You have to default to the data of her demographic. You have to assume she will behave like the average 17-year-old. And the average 17-year-old, statistically speaking, is a financial nightmare for an insurance company. They are not insuring you, the responsible, careful teenager who always wears a seatbelt and never texts and drives. They can't. They are insuring the statistical probability of a 17-year-old. They are insuring against the thousands of other 17-year-olds who will speed, who will get distracted, and who will make a critical error in judgment. Your premium is paying for their mistakes. It feels incredibly unfair, but from a business perspective based on risk pools, it's the only way they can stay solvent. But why? Why is the data so skewed? Is it just a lack of practice? That's part of it, but it goes much, much deeper than that. It goes right inside your skull. The human brain, specifically the prefrontal cortex, is the command center for what we call executive function. It's the part of the brain that governs rational decision-making, impulse control, risk assessment, and understanding future consequences. It's the little voice that says, hey, maybe taking this blind corner at 60 miles an hour is a bad idea. Or, maybe I should wait for my friend to finish their story before I look over at them. And here is the critical scientific fact that underpins the entire teen insurance industry. The prefrontal cortex does not fully mature until your mid-20s. Around age 25. This isn't an opinion. This is settled neuroscience. A 17-year-old's brain is, quite literally, still under construction. The very hardware needed to consistently and accurately assess risk isn't fully installed yet. So when a teenager gets behind the wheel, They are operating a 2-ton machine at high speeds with a brain that is biologically hardwired for impulsivity and a dampened sense of danger. Insurers know this. Their actuaries might not be neuroscientists, but their data models have effectively reverse-engineered this biological reality over decades. The data screams that drivers under 25 take more risks, and the science explains why. You might feel like an adult, but your brain's risk assessment wiring is still that of an adolescent, and that biological fact is priced directly into your policy. This leads to what I call the double whammy effect. It's not just that young drivers get into accidents more often, that's the frequency problem. It's that the accidents they get into are often more severe. That's the severity problem. Why? Inexperience. When an experienced driver starts to lose control on a patch of ice, their decades of muscle memory might lead to a gentle correction. An inexperienced driver is more likely to panic, slam on the brakes, and turn the wheel sharply, turning a minor skid into a multi-car pileup. When a deer jumps out in front of a 40-year-old, they might brake hard and swerve into the shoulder. A 17-year-old might freeze or worse, swerve into oncoming traffic. These moments of panic and poor judgment, driven by that underdeveloped prefrontal cortex, mean that when a young driver crashes, they tend to crash harder. The impact speeds are higher, the damage is more extensive, the injuries are more grave. A simple fender bender for one driver becomes a total vehicle loss and a major injury claim for another. So the insurance company isn't just planning for you to file more claims. They're planning for your claims to be catastrophically expensive when you do. The potential payout is enormous, and your premium has to reflect that enormous potential loss. And then there's the single biggest risk multiplier of them all. The one factor that can take an already high-risk situation and send it into the stratosphere. Passengers. Specifically, other teenagers. The data on this is chilling. According to the AAA Foundation for Traffic Safety, a 16 or 17-year-old's risk of dying in a crash increases by 44% when they are carrying just one passenger under the age of 21. Add a second passenger and the risk doubles. Add a third or more and the risk quadruples. Think about that from an insurer's point of view. A solo teen driver is a massive liability, but a teen driver with a car full of their friends isn't just a liability. It's a ticking time bomb. The distraction level skyrockets. The potential for peer pressure to speed or show off becomes immense. And most importantly, the potential for a single accident to result in multiple life-altering injuries or fatalities goes through the roof. One bad decision doesn't just impact one person. It could lead to 4 or 5 separate, massive liability claims from a single incident. That is the absolute worst-case scenario for an insurance company, and they have to price every single teen policy as if that scenario could happen tomorrow. So you're a statistic. A number on a spreadsheet that screams high risk. You're guilty by association with your own age group. Feels completely unfair. But what if I told you there are ways to break out of this statistical prison? Ways to prove to the insurance company that you are the exception, not the rule? Because there are. And they start with understanding the specific levers you can pull inside their own system. Let's start with the most powerful lever. And it's one that might surprise you. It's not about your car or even how you drive. It's about your report card. It's called the Good Student Discount. And I know it sounds lame. It sounds like something your parents made up to get you to study for your history final. But in the cold, hard world of insurance algorithms, it is pure gold. Think about it from their perspective. An actuary, a person whose entire job is to predict the future based on data, is looking at 2 identical profiles. 2 17-year-olds, same town, same car. But one of them has a C- average, and the other has a B+ or higher. Which one does the data suggest is more responsible? More likely to follow rules? More likely to be conscientious behind the wheel? The one who shows up and does the work. The one who demonstrates discipline. It's a proxy. A signal. Good grades signal to the insurance company that you are a lower risk, that you possess the kind of forward-thinking and rule-abiding nature that makes for a safe driver. And they don't just give you a pat on the back for it. They reward you with cold, hard cash. This discount isn't a measly 1 or 2%. We're talking 10, 15, sometimes up to 25% off your premium. That's not pocket change. That could be hundreds, even over $1,000 a year, just for doing what you're supposed to be doing anyway. So, if you're in high school or a full-time college student, typically under the age of 25, your GPA is one of the single most effective tools you have to fight back against high rates. You are literally turning your academic effort into a massive recurring discount. The next lever is a direct upgrade to your driving skills. a credential you can wave in their face. It's completing a certified driver's education or defensive driving course. Again, this isn't just about learning to parallel park. The insurance company sees that certificate as proof that you didn't just learn enough to pass the DMV test. You were professionally trained. You were taught to anticipate hazards, to understand vehicle dynamics, to manage risk in a way that the average self-taught or parent-taught driver wasn't. It's a formal declaration that you have invested time and effort into not just being a licensed driver, but a skilled driver. They know that a student who has completed one of these courses is statistically less likely to get into an accident in their first few years on the road. And for an insurance company, less likely to have an accident is the most beautiful phrase in the English language. So they incentivize it. They offer a discount because you have actively and demonstrably lowered your own risk profile. You've given them a reason, a piece of paper, to believe you are better than the average young driver. But what if you want to go even further? What if you want to prove it to them in real time? This next lever is the most direct, most powerful, and for some, the most controversial way to slash your rates. It's called telematics. You probably know it by the names of the programs. Progressive has Snapshot, State Farm has Drive Safe and Save, Allstate has DriveWise. It's a deal, a bargain you strike with the insurer. You say, "You think I'm a risky driver because I'm young? Fine, watch me." And they do. Using a small device you plug into your car or an app on your smartphone, they monitor your actual driving habits. They aren't watching where you go but how you get there. They're tracking a few key behaviors that are highly correlated with accidents. First, hard braking. Are you constantly slamming on the brakes because you're following too closely or not paying attention? Or are you braking smoothly and anticipating stops? Second, rapid acceleration. Are you peeling out from every stoplight like you're in a drag race? Or are you accelerating gently? Third, the time of day you drive. Driving at 2 p.m. on a Tuesday is statistically far safer than driving at 2 a.m. on a Saturday. They know that late-night driving, especially on weekends, is when the most serious accidents happen. And fourth, and this is the big one now, phone use. The app can detect if you're handling your phone while the car is in motion. Every trip you take becomes a test. You are actively generating a safety score. You are replacing their statistical guess about you with your own personal, real-world data. If you are a genuinely safe driver, if you don't speed, you don't tailgate, you don't text and drive, this can be a game changer. The discounts can be massive, sometimes as high as 30 or 40%. You are showing them, with undeniable data, that you are the exception to their rule. Of course, there's a flip side. This is a bet on yourself. If you drive poorly, if you're constantly braking hard and driving late at night, this program can actually work against you with some companies. It's the ultimate put your money where your mouth is option. You're trading a bit of privacy for the chance to prove you deserve a lower rate. For a safe young driver stuck with a high premium, it can feel like the keys to the kingdom. Now, let's talk about a lever you pull before you even get a quote. A choice that can define your insurance fate for years to come. The car you choose to drive. For a young driver, the car is not just a car. It's a massive multiplier on your insurance rate. You could be the safest driver in the world, but if you choose the wrong car, you are starting the game on the highest difficulty setting. Insurers look at three main things. First, the cost to repair it. A 10-year-old Toyota Camry and a brand new BMW 3 Series might get into the exact same fender bender. The repair on the Camry might be $1,000. The repair on the BMW, with its complex sensors, expensive paint and high-end parts, could easily be $5,000 or $10,000. The insurer knows this. They have databases filled with repair cost data for every single make and model. Driving a car that's cheap to fix is a built-in discount. Second, they look at its safety record and features. A car with a 5-star crash test rating, automatic emergency braking, lane keep assist, and blind spot monitoring is a car that is actively trying to prevent an accident or reduce the severity of one. This means less risk of a catastrophic injury claim, which are the multi-million-dollar claims that keep insurance executives up at night. A safer car directly translates to a lower premium because it reduces the potential for a massive payout. And third, they look at theft rates. Is this a car that's frequently targeted by thieves? The recent explosion in thefts of certain Kia and Hyundai models is a perfect example. Insurance companies had to pay out claim after claim after claim for these stolen vehicles, and as a result, the premiums for those specific models went through the roof, in some cases becoming completely uninsurable for young drivers in certain areas. So choosing a boring, reliable, safe, and common car, like a Honda Civic, a Toyota Corolla, or a Subaru Forester, is one of the smartest strategic moves you can make. It might not be the car you dream of, but it's the car that will save you thousands of dollars, money you can put towards the car you really want in a few years when your rates naturally come down. Finally, there's a lever inside the policy itself. It's about understanding what you're actually buying and customizing it to your needs. When you get a quote, it's not one single price. It's a collection of different coverages. By understanding them, you can adjust your policy to save money. The biggest adjustment you can make is to your deductible for collision and comprehensive coverage. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. If you have a $500 deductible and get into an accident that causes $3,000 of damage, you pay the first $500, and the insurer pays the remaining $2,500. Here's the secret. The higher your deductible, the lower your premium. By raising your deductible from, say, $500 to $1,000, you are telling the insurance company that you are willing to take on more of the initial financial risk yourself. This makes every claim less expensive for them, and they pass those savings on to you in the form of a lower monthly or semi-annual bill. You have to be honest with yourself. Can you afford to pay $1,000 or $1,500 on a moment's notice? If you have an emergency fund, this is an incredible way to lower your fixed costs. You can also ask yourself if you even need full coverage. If you're driving a 15-year-old car that's only worth $2,000, does it make sense to pay an extra $800 a year for collision coverage that has a $1,000 deductible? In that scenario, the absolute most the insurance company would ever pay you is $1,000. You're paying $800 to protect $1,000 of value. The math just doesn't work. For older, low-value cars, sometimes dropping collision and comprehensive coverage and only keeping liability, which is the part that's legally required, is the most financially sound decision. These aren't just tips. This is a fundamental shift in how you should approach car insurance. You are not a passive victim of the system. You are an active participant who can pull specific, powerful levers to change your outcome. You can leverage your grades, your training, your real-world driving habits, your choice of vehicle, and your policy structure to fight back and systematically dismantle the high-risk profile they've assigned to you. But these are just the levers you can pull on your own. What if I told you the biggest savings of all come from leveraging something you probably already have? Your family. That's right. Your family. This isn't about asking for a handout. This is about understanding the fundamental structure of insurance and using it to your advantage. It is, without a doubt, the single most powerful cheat code for slashing the cost of car insurance when you are young. And it all boils down to one simple action: staying on or being added to your parents' or guardian's car insurance policy. Now you might be thinking, of course that's what everyone does. But do you know why it works? Understanding the why is what transforms you from a passenger in this process to the driver. When an insurance company looks at you, a 17, 18, or even 22-year-old, they see a blank slate. A high-risk, statistically dangerous, expensive blank slate. But when they look at your parents, they see the complete opposite. They see decades of driving history. They see a long-term established credit score. They likely see a homeowner, which is another massive indicator of stability. They see loyalty with years spent at the same company. Your parents' insurance profile is a fortress of low risk. Your profile is an open field. By adding you to their policy, you are essentially being brought inside the fortress walls. Their decades of good behavior, financial stability, and proven track record act as a massive counterweight to your statistical risk. The insurance company is no longer just underwriting a teenager. They are underwriting a household, a multi-generational unit, and the overall risk of that unit is dramatically lower than your risk as a standalone individual. It's like adding one new untested link to a massive heavy-duty chain versus trying to tow a car with that single new link all by itself. One is a minor adjustment, the other is a recipe for disaster. The savings here aren't small. We're not talking about 10 or 15%. For many young drivers, getting a solo policy can cost 2, 3, even 4 times more than being added to a family plan. We're talking about a difference that can easily exceed thousands of dollars per year. This is the single biggest financial lever you can pull. So how does this work in practice? Let's break it down. If you're living at home and driving a family car, it's straightforward. Your parents call their agent, add you as a listed driver on their policy, and that's it. Yes, their premium will go up. Let's be very clear about that. Adding a young driver is the single biggest event that causes a family's auto insurance rates to jump. But the key is to compare the increase on their policy to the astronomical cost of a separate policy for you. The math will almost always favor the family plan. And it's not even close. But what if you have your own car? This is a common point of confusion. Many people think, if I buy my own car, I need to get my own insurance. That is almost always the most expensive mistake you can make. In most states, as long as you are living in the same household, you can add your own car, titled in your own name, to your parents' policy. It becomes a multi-car policy. Now you're not just benefiting from their driving history. You're unlocking a whole new set of discounts. The multi-car discount is one of the most significant discounts an insurer offers. By adding your car to their existing one or two, you're giving the company more business, and they reward you for it. The discount applied across all the vehicles on the policy can often significantly soften the financial blow of adding a young driver and a whole new car. And it goes deeper. Remember the bundling discount we talked about? The one you can't get on your own because you probably don't have a homeowner's policy? Well, when you're on your parents' policy, you are indirectly benefiting from their bundle. Their discount for having home and auto insurance with the same company is helping to lower the overall premium, a premium you are now a part of. You are inheriting the benefits of their financial stability. Think of your parents' policy as a master account that has unlocked all the premium level discounts. By joining it, you get access to all those perks without having to qualify for them on your own. Now let's address the elephant in the room for many of you: college. What happens when you're no longer living at home full-time? This is where you can find some of the most overlooked, yet massive savings. It's called the Student Away at School discount. If you attend a college that is typically more than 100 miles from your home, and you do not take a car with you, you can't be racking up miles and you can't be getting into accidents. The insurance company's risk plummets. As a result, they offer a huge discount. You remain listed on the policy, so you're fully covered when you come home for winter break or for the summer. But the company acknowledges that for 9 months of the year, you're not a primary driver. This can reduce the cost of insuring you by a significant amount, sometimes 15% to 30%, while keeping you continuously insured, which is critical for your long-term insurance score. You absolutely must have this conversation with your family if this situation applies to you. It's free money being left on the table. Even if you do take a car to college, as long as your permanent address is still your parents' house, you can typically remain on their policy. The garaging address for your car might be updated to your college town, which could slightly increase or decrease the rate depending on the location, but the foundational benefits of being on that established multi-car bundled policy will still far outweigh the cost of going it alone. This entire strategy is about playing the long game. Staying on your family's policy isn't about being dependent. It's about being strategic. Every year you spend on their policy driving safely without accidents or tickets, you are building your own personal driving history. You're no longer a blank slate. By the time you're 25 or you move out and get your own place, you won't be starting from scratch. You'll be going to an insurance company as a 25-year-old with, say, 9 years of continuous claim-free driving history under your belt. That history, even though it was on your parents' policy, is your history. You've used their low-risk fortress not just as a shield, but as an incubator. You've built your own track record under their protection. When you finally launch your own policy, you'll be treated like a responsible, experienced driver, not a risky novice. You'll get the rates you deserve because you've proven yourself. This is the transition. It's the bridge from being a high-risk teenager to a low-risk adult. And it saves you an absolute fortune along the way. It requires a conversation, a mature, financial conversation with your parents about shared responsibility. It's about showing them you understand the risk, you appreciate the help, and you're committed to being the safest driver you can possibly be, because your actions now directly affect their finances. So you've optimized your driving habits. You've stacked every discount you personally qualify for. And now you've leveraged the single most powerful structural advantage you have: your family's insurance history. You have built the absolute strongest possible case for a lower rate. You've done everything right on paper. But there's one final step. The one that separates the passive consumer from the proactive expert. It's the art of the phone call. It's knowing exactly what to say, what to ask for, and how to make the insurance companies compete for your business, putting all this hard work into action to get a real-world number that saves you money, right now. And in the final part, I'm going to give you the exact script. Alright, grab a pen, open a notes app, or just get ready to screenshot, because this is it. The culmination of everything we've learned. This isn't just a script. It's a negotiation framework disguised as a phone call. The goal is to project confidence, preparedness, and to guide the agent toward the discounts you deserve. You are not just asking for a price. You are presenting yourself as the ideal low-risk young driver they want on their books. Before you dial, have this information in front of you: your driver's license number, the car's VIN number, the exact make, model, and year, your current address, and a copy of your report card or transcript if you're a student. Preparation is the first step to looking like a serious customer. Okay, let's do this. You dial the number. An agent picks up. Take a breath. Here's what you say. Phase 1, the opening. Hi, my name is, your name. I'm calling to get a competitive quote for a new auto insurance policy. I'm a young driver and I'm currently comparing rates from a few different companies to find the best value and coverage. Let's break that down. Competitive quote signals you're not a first-time caller just kicking tires. Says you know there are options. New auto insurance policy is clear and direct. I'm a young driver gets straight to the point and shows you aren't trying to hide it. You're tackling the main issue head-on. And the killer phrase, I'm currently comparing rates from a few different companies. This is the single most important sentence in the opening. It immediately reframes the conversation. You are not a captive audience. You are a savvy shopper. It puts them on notice that they need to earn your business, not just give you a boilerplate price. It lights a fire under them to find you the best possible rate, because they know you have other options lined up. Phase 2. The information exchange. The agent will now start asking for your details. Your name, date of birth, address, driver's license number, the car's VIN, etc. Provide it all calmly and efficiently. This is where having it all in front of you makes you look organized and responsible. 2 traits insurance companies love. They will ask about your driving history. Be honest. If you have a clean record, say it with pride. I have a completely clean driving record. No accidents or tickets. If you have a minor incident, be upfront but frame it correctly. For example, I had one minor fender bender over 2 years ago, which has since cleared from my record, but other than that it's clean. Once they have the basics, they'll likely give you an initial sky-high quote. Do not react with shock. Do not get discouraged. This is just the starting point. This is the lazy number. Now we go to work. Phase 3, the discount deep dive. This is where you take control of the call. You are now going to be the one asking the questions. Use this exact sequence. You say, okay, thank you for that initial number. Now I'd like to make sure we've applied all the available discounts to get that number down. Can we go through them together? This is polite but firm. You're not accusing them of hiding things. You're inviting them to work together. Then you start the checklist, one by one. First, let's start with education. I'm a student with a mention your GPA, for example, 3.5 GPA. Can you confirm the good student discount has been applied? Let them answer. If they say yes, ask how much it saved you. If they say you need to submit proof, say, great, I have my transcript ready to email over right now. What's the best address for that? Second, I've also completed a certified defensive driving course. What kind of discount can you offer for that? Again, have the certificate of completion ready. This shows proactive risk management. You are literally a trained safer driver, and you have the paper to prove it. Third, this is the big one. I'm very interested in a usage-based insurance program. Could you tell me about your telematics or mobile app program, like Drive Safe or Snapshot? I'm a very safe driver and I'm confident my habits would earn me a significant discount. What's the potential savings with that program? This is a huge signal. You are so confident in your safe driving that you are willing to be monitored. To an insurer, this is music to their ears. It screams low risk. Fourth, let's talk about the vehicle itself. It has anti-lock brakes, airbags, and an anti-theft system. Can you confirm the discounts for those safety and security features are included in this quote? Many agents just forget. You are reminding them. Don't ask if there's a discount. Ask them to confirm it's been applied. Fifth, I'd also like to know about payment options. What is the discount for paying the full 6-month or annual premium upfront versus paying monthly? This can often be a surprise 5 to 10% savings right there just for how you pay. It also shows you are financially responsible. Sixth, and this is a forward-thinking move. I know I'm only insuring one car right now, but what do your multi-policy discounts look like for bundling with renters or homeowners insurance in the future? I like to plan ahead. Even if you live at home, asking about a renter's policy bundle shows you're a potential long-term, multi-line customer. They want to keep customers like that. It's a psychological play for a better price today. After each question, pause. Let them check. Let them recalculate the quote. You will literally hear the price drop with each discount they apply. Phase 4, the closing. After you've gone through the discount checklist, they will give you a new, much lower number. Now for the final power move. Regardless of what the final number is, you say this. Okay, that's a much more competitive number. Thank you for taking the time to find those discounts with me. As I mentioned, I'm gathering a couple of other quotes today, and I'll be making my final decision this afternoon. Could you please email me the full quote with the breakdown of the coverage and the discounts we discussed, along with the quote reference number? I'll be in touch. Let's dissect this masterpiece. That's a much more competitive number. Gives them positive reinforcement. Thank you for working with me. Makes them feel like a partner, not an adversary. I'm making my final decision this afternoon. Creates a real believable deadline. It tells them they don't have weeks to win you over, they have hours. This might even prompt them to say, hold on. Let me see if my manager can approve any other discretionary discounts to help you make your decision today. It's amazing how often that works. And finally, could you please email me the full quote with the breakdown is non-negotiable. You need this in writing. It allows you to compare apples to apples with the other quotes you're getting, and it holds them accountable for the price they gave you. And that's it. You end the call politely and professionally. Now here's the secret. You have to actually do it. Call at least 3 different companies. Use this exact script and framework for every single call. You will be astonished at the difference in the quotes you receive. One company might value your GPA more. Another might give a massive discount for telematics. You won't know until you call. Lay the emailed quotes out side by side. Don't just look at the price. Look at the coverage levels. Make sure you're comparing identical policies for bodily injury liability, property damage, and your collision and comprehensive deductibles. Choose the one that offers the best combination of price and coverage from a reputable company. Then you call them back and say, "Hi, it's your name. You gave me quote number 12345 earlier today. I've made my decision, and I'd like to start that policy." You did it. You didn't just accept the first price they threw at you. You didn't just get angry at the system. You took control. You used knowledge, preparation, and a strategic script to navigate a complex system and save yourself hundreds, maybe even thousands of dollars. The reason youth car insurance is so expensive is based on statistics, on the average behavior of a massive group. But you are not an average. You are an individual. And by following this guide, you've just proven it. You've presented yourself as the exception to the rule, and you've made them price you that way. This is the blueprint. Now go build your policy.